Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a different aspect from the world of investment and look to apply the rules of value investment as laid down by the father of the craft, Benjamin Graham, to the problem at hand. In this episode, we take a look at what are often described as legacy businesses. We are talking of those businesses that have operated for many decades, even centuries, but in today's investment climate are often overlooked as destinations for an investor's capital. These businesses oftentimes operate in industries that many consider to be moribund, operations concerned with oil, gas or tobacco. We should take a look at these industries and consider the pros and cons of investing in such legacy businesses and consider ultimately whether they make a good choice for those following the value approach. So without further ado, let's dive right in. As ever, pour yourself something caffeinated and get ready for another lesson in value investment as prescribed by the man himself, Benjamin Graham. Let's start with what is an undeniable fact. Legacy businesses such as oil, gas and tobacco firms have a tendency to be very unpopular with the investment community as a whole, and there are a myriad of reasons for them being so. Number one is that they do not offer the very thing that the great body of investors seek when choosing in what stocks to invest. Legacy businesses, more often than not, lack a growth story. Take the oil and gas industry. Whilst we may not yet have reached peak oil demand, that day does not seem too far off. And the long-term future for fossil fuels seems bleak, despite recent setbacks to reach net zero. The industry might have left in it a few more steady years, but the final destination seems certain enough. Least not because if we want a world fit to pass down to our descendants, we are going to have to stop filling it with CO2 pretty quickly. Like I say, oil may be a lot of things, but a growth story it is not. Likewise, take the tobacco industry. Its historic cash cow, that is the humble cigarette, seems to have had its day. Already in the more economically developed countries, we are seeing steep declines in smokers, put off by the health risks as well as the high taxes imposed on them. It seems doubtful that the supposedly less harmful alternatives like vapes can fully make up for losses in this revenue stream. Whilst the number falling away from tobacco products globally is more of a trickle than a mass exodus, the industry cannot be said to be a growth one. And for that reason, many equity investors will overlook tobacco stocks as a destination for their wealth. Whilst the lack of a growth story is important, it is clearly not the only reason why legacy businesses have proven to be unpopular with many investors of late. Clearly, there are a number of negative moral connotations that go hand in hand with businesses in the fossil fuel arena, as well as with the tobacco companies. It barely requires explaining that the climate debate has moved on pretty quickly in the last decade or so, and most people now accept that our want for burning fossil fuels is having a serious impact on our planet, an unsustainable impact, and many people are not okay with what could be seen as profiteering from this. Likewise, there is a moral debate around making money from something that is both highly addictive and very harmful, as with the tobacco companies. This means that there are a good body of individual investors, and even more importantly, from a valuation standpoint, many institutional organisations who shun these industries for moral reasons alone. The lack of a growth story and the ethical considerations around legacy businesses like these means that many investors would not touch oil, gas and tobacco sectors with a proverbial barge pole. This inevitably means that valuations are likely to be lower than they would otherwise be. The knock-on effect of this unpopularity is that we have a tendency to see comparatively large dividend yields and return to shareholders through share buybacks by these companies. For instance, the average dividend yield for the S&P 500 currently sits at around 1.2%, yet the tobacco company Altria sits at almost 7%, with the oil major Chevron around 4%. Returns for other businesses around the globe in these sectors tend to be similarly outsized. This means that as unpalatable as it might be for some, there exists some serious value opportunities in these sectors. Putting to one side for just a moment the moral concerns that some might have investing in these sectors, let's look at these businesses purely as a value proposition. Let's first consider tobacco stocks. While some of the allure that made businesses operating in this industry such a favourite with investors in the past has reduced, many of the favourable characteristics from a financial standpoint remain. Tobacco products are highly addictive, extremely profitable, and virtually recession-proof. They may no longer be the growth story that they once were, but still hold one of the most attractive qualitative traits available to the value investor. That is the dependability of its earnings. Revenues and profits in this sector have a tendency to show a dependability year after year that many in more cyclical sectors could only dream of. And this makes the job of the value investor a much easier one, allowing them to arrive at a much more definite idea of a business's intrinsic value than if they were attempting to value a business that had wild swings of earnings between big profits and big losses. A similar picture emerges with the oil and gas sector. Whilst earnings are prone to much greater volatility than is typical in the tobacco industry, which is a result of fluid pricing in fossil fuel markets, oil and gas are also highly addictive for the users and, most importantly, profitable, although of course much less recession-proof. Fluctuations from year to year mean earnings are less dependable, but taken over time, there is no question that it is a highly lucrative sector in which to operate. So what can we say of the tobacco and the fossil fuel industries as a destination for investment by the value investor? Both of these plays are likely to rely upon outsized dividends and distributions through share buybacks as the chief source of value for the investor. Whilst they may very well, strictly speaking, be misvalued, returns via large increases to market capitalizations are less likely to be the prime incentive to invest in these businesses. For the prime cause of undervaluation is likely to be hard baked into these industries as a result of the negative connotations of each. There will always exist a great body of investors who will not invest for moral reasons, or as a result of the lack of any growth story. This may make a large rebound and reassessment in valuations a somewhat distant prospect. But as we've seen with the similarly controversial military sector, sometimes unseen factors can intervene to make once rather dull sectors suddenly become flavour of the month. In my view, the tobacco and oil and gas sectors can make an objectively attractive addition to any portfolio, but the justification for selection of these stocks is likely to require a different mindset from the stocks that will typically look attractive to the value investor. Usually the value investor will be looking to the appreciation in the price of stocks to derive profitable outcomes. With these sectors, prices may never return to levels justified from a purely objective analysis of the accounts. However, the highly attractive and often dependable dividend yields, as well as other forms of investor redistribution of profits, can somewhat sugarcoat this state of affairs, potentially making it an attractive hedge against more volatile industries within the portfolio. This brings us back to the elephant in the room. The moral aspect is of course a very personal decision, but it has already been enough to dissuade many investors into entering into positions in these sectors. These concerns are of course very real and valid. Climate change is happening before our very eyes, and it's true that the oil majors are simply not doing enough, quickly enough, to transition away from fossil fuels. This begs the question, do we want the owners of these businesses, aka the shareholders, the folks who have the ultimate say in the direction of travel for any business, to be those people concerned with climate matters, or do we only want those with little regard for our planet pulling the strings? As an example, the world's largest sovereign wealth fund, the Norway Government Pension Fund, which owns something like 1.5% of all listed businesses globally, excludes tobacco companies from its portfolio. The question is, would a more pragmatic approach to using the influence that a stake in the business allows to accelerate the phasing out of the most dangerous products be a morally more responsible position? As an aside, the Norway Fund is perfectly okay with investing in the oil majors, as it might well be given that the fund was set up to invest surpluses from the country's petroleum sector. To these questions I cannot give you an answer. It will be for your conscience and sensibilities to decide. In summary, investment in sectors that seem to be trading cheaply based on their financial showing, but are nevertheless perennially discounted, partly due to the perception that the industry lacks a growth story, and partly because the industries are morally contentious, can make an attractive but unusual addition to a value investor's portfolio. Unusual because, unlike as is typical for the value investor, they are probably looking to derive value from the attractive redistribution of earnings rather than from an increase in capital through re-evaluation of share prices. For those concerned with the moral dilemmas this throws up through profiting from something that demonstrably does damage to our planet and fellow citizens, need to ask themselves whether they are better off served conscientiously objecting to taking part in investment within these industries, or whether an actively held stake can force the company to take an accelerated path to net zero or towards less harmful products. You, my friends, are the only ones who can answer that important question. That is all for today's edition. A bit of a deep one this week, but nevertheless, I do hope you've enjoyed it. If you did and you haven't done so already, you can add to playlist so that you will receive alerts whenever a new edition lands. And do, as ever, continue to spread the word to make this community of like-minded investors as big as possible. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.